Hey, good day, good day. I'm going to go through this as I read it. All right, let's see what we have here. Okay, hold on. Holy fuck. This thing was long. Okay, I watched the whole video. Since you did not call me, you did not understand my business. I'm sorry. My negative. The end of the year because I carry payroll forward. Yes, this is very common. I get that. Okay, I carried that. Yes, this is a carry forward. This is very common. Um, pay okay. What if you would call me out? Cards paid. Yeah, we can go through the credit cards now. Hold on a second. In fact, Americ, I made a mistake. I overpaid. Negative balance. Okay, that's fine. I just sent you a statement to your email for the weekend. I'm just can understand everything. Okay. Again, your American Express does not appear on your credit, nor does it appear in Yuji's credit. We're not counting American Express. You may have an American Express business, which at this moment, for whatever reason, is not reporting. That's fine, but it's not reporting. Okay, your discover's at 0. That's fine. Okay. Yes, your P&L. The thing is that the P&L is not audited. It's a non-audited, meaning we go off the 2 years of tax returns. The P&L is just it's bogus between you and I because you can put whatever you want on that P&L. And this is I don't know if you caught it in the video yesterday, but what I mentioned is prior to COVID, we never used to use P&L. As a matter of fact, I was the one that got that written away on PRMG. When I came in PRMG in 2015, we used to use P&L. And I had a massive argument with them stating that anybody could put anything in it. They went and spoke to Fannie Mae because I had a big blowout, which lasted like almost a month and a half. And after that, they made new rules at PRMG, no P&L anymore. Now, according to COVID guidelines, again, it has nothing to do with you. COVID guidelines are stating that the borrower, a self-employed borrower, needs to demonstrate that they have basically, in essence, survived COVID or are functioning during COVID. There's no way of really telling whether you do or you do not. Okay, I mean, think about it. We're not really. There's no way. So Fannie Mae said, "Listen, take a P&L." We're like, "Okay, take a P&L," but the P&L is bogus. This is an argument we've had internally. I take stockholder returns, the commissions throughout the year. It does not come out. Oh, you can't see the. Okay, wait a minute. Doesn't come out. Yeah, into the W-2. Yes, these are distributions, but your distributions on the video that I showed you yesterday, you take a distribution, but your income, your losses also reflect on your personal. I don't even know if we can Google that, but hold on a second. So on a 1120S, no. Okay. Do the losses of small business reflect on personal? Let me see. S corporations affect. You see, your business losses affect your individual tax returns. You can deduct business losses from your personal income statement the same way as a sole proprietor does. Chapter C owners cannot deduct. That's what I said in your video yesterday. If your business was a Chapter C, the losses stay with the company and do not transfer to you. At this moment in time, they're transferring to you. And between you and I, and this is a discussion for another day. I would say, I believe a Chapter C corporation is way better than a small business. I know I'm going to have arguments from accountants saying no, but I have other reasons for it. But this is the problem. You're taking distributions, you're taking W-2s, and you're taking whatever the business loss as well, which I know you're telling me that it's cash basis. You only have two. You have accrued basis um, and cash basis. Those are the only two. That's the way the accounting is. So we call it a carry forward, meaning that you're owed money. That's exactly what you told me. You're owed money and you're carrying it forward to the next quarter. That's okay. But either way, You didn't even show that you had money left at the business the end of the year. Let me show you why. Give me 1 second. Let me see if I bring up. Okay. Um, by the way, we have solutions for this. I'm just showing you more than anything. Is now I want to have an argument with you. I just want you to show you as to the why. So in the future, you understand. I mean, not that you're going to probably, I don't know, it's just something what I call carry forward. In other words, it's more for knowledge than having this thing. We're going to resolve it, but I just want you to understand where we're coming from and why. Because one thing is that yes, your accounting is. I'm not saying it's incorrect. It's correct, but it really doesn't reflect that you make money. Yes, I know you make money. This is the argument I have every day with borrowers that are self-employed. There's a difference between what the accountant places and what is on paper, and also what you see coming into your bank account. But let me see something. I'm looking for your liquidity. Oh, here we go. Why did I? Oh, because I ignored it. Okay. Let me go back to the first one. Okay, let me take this X off. Let me go back to liquidity. This is what we call liquidity is a cash flow, what your business has in cash flow. Oops. For 2018, and this is on your, I'm going to show you where it's at. For 2018, your accountant put to you ended up not on a negative loss. That's not what I'm talking about. Besides the loss, we're talking cash on business, like a cash flow. Like after you make all your income and your expenses, you total, your business has a net 33 bucks. I was like, whatever. I didn't even realize that. But I checked that out. I was actually going through it like a fine tooth comb yesterday. I was tripping. And then your 2019, he put absolutely nothing. Now, where do you get this? Is here. Let's go to your tax. Again, this is not, this is more for FYI. Take it for FYI. Because you got a business now, and it's best that anything going forward, because if you went out to get like a multi-million-dollar loan, you're going to have a very big problem getting it. I kid you not. So again, this is more for FYI. Hold on a second. All right, so let me see. Where is your tax? Is that your tax returns? Give me 1 second. Better. Okay, 2019 personal and business. So let's see here. Okay, here you see where it says total assets, see instructions. That's the 2019. This should have an amount. It's a carry forward from the previous year. I mean, from the ending of the year. He put zero. And so I was like, again, everything that comes in, I get it. You're going to tell me I make a million. Yeah, you got a million in receivables and you got 800,000 in payouts. Probably part of that payout is money that you take for yourself. I get it too, but it doesn't reflect it that way. It looks as an expense. Then we have $242,000 in what we're going to call net gross profit, not net profit, gross. In other words, after your expenses, you basically have this amount. And then you have an additional income of, I don't know, 802. I got to go and see what he put it for, but it was 800 bucks. So now you got a gross amount of 242. And then from 243. And from 243, you cut a $32,000 check to you because it's a compensation to officers. And then you took from here distribution and wages. You also took some from the 179. So the thing is, the money that you earned here, the 32 and out of part of the 79, which was about 60 something thousand, and I get it, probably the bulk of your money came from the 837, but it's not showing that way. This money now carries forward to your personal. Here, 67,000, and then we have a deduction for the car for 14,000. So in reality, now it's showing that you only made 40,812. And the first 20, you're married, so the first $24,000 you don't pay taxes. So, between you and Yuji. So Yuji already paid her taxes because it's being deducted through Univision. I get it. And then, so you're only paying from, let's say, just like 20 out of $20,000, you're really paying taxes. You're not paying taxes, not a lot, but you're You're not paying in comparison to, again, because the other money is being expended. And it's fine, and it's a carry forward. But the company doesn't look like it has cash on hand. It just doesn't. There's no cash flow. So anyway, that's for that. Now let's go back to your loan. Hold on a minute. Come on, computer. Now talking about it, probably the original loan that you were trying to get, that you were telling me you wanted to get originally, you didn't get, is probably because of your tax returns. You just don't have any cash on hand. You're basically expending what you have in our system. Let me actually show you while this thing comes up. See how it gives me like a little red. This is just a ratio. It just means that the company has more expenses than income. I know that's not what you're going to tell me, but reality is that's the way we look at it. This is like a little thing to us. And that's why it's under the liquidity, meaning how liquid is your business. Funny thing is, for $33, they gave you a positive. And let me see something. I think I have your losses somewhere in your Schedule C. See, these were monies that you were paid out in. And, oh, yeah. And here were the losses that basically is calculating. It basically has, you had a small loss in 2018 and a, 39,000% increased loss from the previous year. Hold on. Now, let me also say, okay, I think everything we're talking about, I have paid off except for the car. The credit line is only $300. All my credit cards are at zero. I've just paid, okay, blah, blah, blah. I have cash balance sheet. Yeah, yeah. Okay. Again, I just want to be clear. We're not taking your current income because there's no way of the self-employed. We don't determine what the current income is currently, what you have. That's not really the issue. So let's talk about, again, what you got to pay off. So right now, the system is showing that theoretically you can get the loan based on the way the underwriter set it. Now, again, this is underwriter, the way she basically placed it. So let me show you what she did. She put, the real kicker is that she put this $544 to be paid. Now, the problem is this credit report right here, that's not a correct credit report. This was an error on the processor. The processor When he added you, again, I was not able to add it because I don't have access to the file. Once it goes to the processing department, they block me out. I can just see, but I cannot make any adjustments. All right, so basically the processor, when he was supposed to import the liabilities, he did not import the liabilities. So we only have one car. There should be two cars from State Farm, one for 544 and one for 530. And I realized this yesterday when you were sending the paperwork that you have there are two Discovers, Yuji's and yours. I don't know if they're two Merrick because I didn't realize that, but I know they're two State Farms, Yuji's and yours. So what happens is now when it goes back to the underwriter is going to, if I give it because what she ended up doing is she added this $390. The reason it gets added, just for you to know, because I want you to where it comes from is bingo. Uh-huh. Okay, what happens is the moment you took the loan out, a UCC, which is that Uniform Commercial Code, it's like a lien, okay, gets registered on OnQ Media. And the SBA charged $100. They took it out of the 80,000 they gave you, and they have a lien. So this through our system, when we run it through something called LexisNexis, which is like a real pain in the butt background check on the company, you have a UCC. So that now sparked off what are the terms? Because we don't know what the terms are. We just see there's a loan against the on Q Media that just got um, applied for. So now you gave us the terms. But like I said, this, just for you to know, this being the EIDL and not the PPP, as well as you know, doesn't get forgiven. You're 100% responsible. And for that reason, it basically becomes your debt. It becomes your debt because there's no payment history. According to Fannie Mae, when you have what's called business debts, and you can go over here and type Fannie Mae business debt, and you go to monthly obligations, and you would pick where the hell's my business debt? Business debt's in the borrower's name. It says the account payment, and this is for SBA, para que tú veas, Small Business Administration loans. The payment does not need to be considered as part of the borrower's DTI ratio if the account in question does not have a history of delinquency. Again, if basically the business provides acceptable evidence that the obligation was paid out of the company funds, such as 12 months of canceled checks. In other words, you don't have any history. And then it says here, the account must be considered as part of the DTI ratio in any of the following situations. If the borrower does not does not provide sufficient evidence that the obligation was paid out of the company funds, well, it hasn't even begun. So that in essence, that's why you're getting hit with that debt and I can't move it. So let's go back. Now let me show you something. Oh, by the way, your credit, the reason it's low here and it can go up significantly, and my thing is fix it. Maybe we can run your credit before and save you a couple of $1,000, believe it or not. I'm going to show you why. This I noticed yesterday because I was going through your file more thoroughly than ever because, believe it or not, I always get a pain in the ass file a year, and yours basically is it. Um, Here's the issue. The Macy's, I know you're probably going to tell me you paid the Macy's, but the Macy's, you went over the amount, the balance. Believe it or not, that throws you off. That will drop your score significantly. Probably you paid it off already. If you have, let me know. But that bumps up your credit, and we can give you, back to no points if it's over like closest to UG. And what's good about that is, you're gonna save you're gonna save some dollars at closing. We'll get into that next. Pero here's the deal: the credit borrower, UG, State Farm, co-borrower, you, another State Farm. Notice that these are not. This one is not there. So all the co-borrowers, which we have, $79 plus $36, and you said you already paid them off, so it doesn't matter. I'm just giving you a heads up, para que tú veas. Plus $30. All right, that's 145. Let me keep that in mind. And 145 plus the car of 530. So we're going to add those debts here. So 145 plus 530, 675. Right? All right. I'm going to just make that I'm going to make that an installment loan. And I'm going to hit it. I'm going to put it on your co-borrower. And here's the deal. Your ratio is over the Fannie Mae limit. Let me just show you, because we're going back to the same thing. Fannie Mae ratio guidelines. You can get all of this is online, but normally it's 45%. This is true. But at PRMG, we do have like a slight override. So we will allow it to go to what? Oh, shit. Yeah, this is 45. This is the original guidelines. Matrix. Hold on. Debt to income ratio. What the fuck? Oh, here we go. So principal purchase 97. Yeah, it says no maximum, but the system actually. Oh, high LTV refi penalty. See, DTI, they want under 45. This is like how all banks are, under 45. The thing is that at PRMG, we kind of guarantee the loan to the government if they go bad for the first 2 years. So they're willing to give us a little bit of flexibility with the DTI. Espérate un segundo. Gotta go to my phone. Say, okay, there we go. So agency is government, which is Fannie Freddie. And notice our ratios are allowed to 50%, but you can't go over 50. All right, so that's that. Now, my whole thing is I need to massage this down. So the underwriter had placed UG's card to be paid originally. What I'm going to do is, since you have paid your credit cards down to zero in your car, we can show that it is being paid by the company. We're going to exclude it, meaning you're not going to pay it. We're going to exclude it. So now your DTI is down to 53%. What I'm thinking is don't want to pay off the car, but you could do the TCF to the point where you almost pay it down and just leave like $500. Then you can just withdraw it the next day here. And let me show you how that looks like. So if you were to leave $20, this is your TCF. If you were to leave it, whatever, to like a $5,000 line. Come on, calculate. Then pay this off, basically. Why is this not working? I know the DTI has to come down. Oh, wait a minute. Okay, hold on a second. Let me put this to $20. If I put 273. Oh, it actually went down to 51. That's what happened. Okay, so all right, give me 1 second, buddy. Hold on. Thinking if I can let the rate expire and get something better. Hold on a second. Because right now you're paying points because of your credit. But if your credit increases because you've paid that down, then let me do this. Hold on a second. We're going to do. Okay. Now I remember. 510 is your base loan. 600,000 is your purchase price. 600,000. And your credit at the moment, because we're using your credit, is 716. I'm pretty sure we probably can get to 720, but let's say I'm going to use 716 for now. See, there was a slight cost because of your credit for 275. So now let me revise this to see if it goes over 620. 720, perdóname. Yeah, it got slightly better. Trying to see if I can go to 2.6. Okay. Oh. Hold on. I forgot. This income goes up to 10,000. Okay. And minus 157. Okay, hold on a minute. Let's see if I can run this. Revise search. I'm going to do a worst case scenario, 716 right now. But what I'm going to do is lender paid MI. The rate is slightly different, but you don't get MI. You don't get MI because basically what they do is they pack in the MI in the front. Yeah, you wouldn't get a rate that low. Am I right? Check. Where did my service button go? Yeah, 3.375. I would be a smidge off. I say that because I wouldn't be paying. There would be no MI. All right, hold on a minute. Let me restart. Crap. Give me 1 minute. I'm going to end the video here because this is too long. Give me 1 minute. The hell's my video?